All right. I'd like to continue to discuss the equity valuation. All right. So, in the first part of equity valuation, we discussed the non-constant dividend growth model. So, in this part, I'm going to do another example of dividend of non-constant dividend growth model. Okay, so that we can actually have a bit stronger impression of this methodology, and we can actually apply this to your real jobs. Okay, in case you become a security analyst in the future. All right, so um, I have just copied this setup from the Excel spreadsheet for equity evaluation. All right, and again, let me just reformat this into green. All right, and let's just look at this setup here. Okay, um, Small Fry Incorporation has just invented a potato chip that looks and tastes like a French fry. All right, and the market is going crazy after this. Okay, and so this company is actually trying to reinvest all of its earnings to expand its operations. All right, so this is really the super normal growth period. Okay, and earnings were $2 per share this past year and are expected to grow at a rate of 20% per year until the end of year 4. All right, at that point, other companies are likely to bring out competing products. Okay, even though I don't know why it takes them so long to actually get into this lucrative market. All right, analysts project or expect that at the end of year 4, Small Fry will actually cut investment and start paying dividends. Okay, well the payout ratio is actually 60%, and the growth rate will actually slow down to a long run rate of 4%, which probably can be justified by, for instance, 4% is the industry average long run growth rate. Okay, if this company's equity cost of capital is 8%, what is the value of the share today? All right, so what's the analysis? Well, the analysis is we're talking about a company that's actually going through phenomenal growth in the first couple of years, and then the growth rate slows down, right? Because competition, because of other similar products. Okay, and so once the company slows down, the company is going to pay the shareholders dividends. All right, so we're looking at future dividends, and we're trying to value the stock. So it looks like this is a dividend discounted model, and we noticed that there is no dividend in the first couple of years because the company is actually going at all full speed. All right, so this is a non-constant, all right, non-constant dividend growth model. All right, and if that's the case, let's actually follow the steps we actually outlined earlier. So this is actually in the first part of this lecture, and I'm going to actually build a simple timeline here, and this is today, and this is 1 year from today, and I don't know how many years I need to have, so I'm just going to have 11 periods here momentarily. And don't forget, this is an infinite horizon, so we're going to actually find a way to cut it. All right, and let's look at well, I think this might be a little too small. All right, so let's now look at first of all, the first piece of information is earnings per share. Okay, let me just denote this by earnings per share, and this recent year, so that's actually $2 earnings per share, so that's the EPS. So what about the earnings per share in the future periods? We don't know, but we may actually be able to figure out. All right, and then we're saying the earnings growth rate, and we're talking about phenomenal growth of 20%. All right, until the end of year 4. So it's going to be growing at 20% for years 1, 2, 3, and 4. All right, so these are actually phenomenal growth period. And then it's going to slow down to 4% thereafter. So starting from year 5, it's going to be 4%. So if you want to have a little critical mind, one question you might ask is, why does the growth rate, slow down all of a sudden? Okay, remember in the previous example, we're talking about, Walgreen, and the Walgreen growth rate actually slows down gradually. All right, it slows down from 13 to 12 and 11 and so on and so forth. So here, from 20 all the way to 4, that seems maybe all of a sudden. Okay, if you want to criticize this assumption, maybe that's something you have in mind. All right, and if that's the case, so now we know the company is not paying any dividends at all in the first couple of years, and then starting from year 5, it's going to pay dividends. All right, so the dividend payout ratio. All right, so starting from year 5, that's going to be 60% of the earnings. In other words, the retention ratio is actually 40%. Okay, earlier we discussed the notion of retention ratio versus dividend payout ratio. All right, they add up to 1. All right, so if that's the case, what should we do next? Well, we know that the company is going to start paying dividends, and we're going after dividends. But the dividends are actually coming out of the earnings, and we have the dividend payout ratio. So the first thing we need to do is to find out what is the earnings in the in the future years. All right, so we have a starting earnings per share today, and we have the earnings growth rate in the first year. So that is 20% growth rate in year 1, and so the earnings per share is going to be $2.4. And now I can actually copy these across, and I can actually calculate all the future earnings per share, all right, in the timeline I have. All right, again, it's still infinite. Okay, we have not applied the Gordon model yet. Remember, in the first part of this lecture, we're trying to cut the timeline by applying the Gordon model. Right, so before we can actually start to apply the Gordon model, we have to find out when the growth rate is going to stabilize for dividends. And for that, we have to find out what are the dividends, okay? And so I'm kind of using the backward induction, so we have to go after earnings per share first, okay? And now we can actually say, hey, I have the earnings per share, at $4.31 in year 5, and they're going to pay out 60% of that as dividends. So yes, I can actually multiply these two numbers, and that means the company is going to actually pay $2.58 per share dividend in year 5. All right, and I can actually copy this across. Okay. All right, so these are the dividends, in the future periods. So if I want to actually find the stock price today, I know it's nothing but the present value of all the future dividends. Now, the only problem is this is an infinite timeline. All right, so the horizon is infinite. So we have to actually find a way to cut it. All right, so I said this already. We're just going to look at when the growth rate is going to stabilize. All right, so dividend growth rate. All right, so based on this, I have the dividends. So yes, I can actually find out what's the growth rate for dividends in each of those periods. So there is no growth rate for year 5 because it's not defined. There's no dividend in year 4. There is dividend in year 5. So the growth rate is actually infinity. All right, so it's not defined. So I'm going to look at year 6 dividend growth rate. Okay, so I have year 6 dividend. I have year 5 dividend. So one thing I can do is I can just do year 6 dividend minus year 5 dividend divided by year 5 dividend. All right, so that will get me the dividend growth rate, for year 6. All right, and that's actually 4%. Okay, and I can actually, copy this across. And now you actually see there's a very interesting pattern here. The growth rate for dividends actually starts to stabilize at 4% from year 6. All right, so can apply the Gordon model. All right, so starting from year 6 at the earliest. Okay. All right, so we know that the Gordon model requires a constant dividend growth rate, and we have that only starting from year 6. Okay, so I'm going to actually calculate, the resale price in year 6. All right, and I can actually look at, year 6, resale price, and remember the Gordon model is forward-looking, so I have to look at year 7 dividend and divide that by R, which is the company's equity cost of capital, which is 8%, minus G. Well, the G is actually well defined in this case. It's actually 4%. Okay. All right. So that will get me the stock price in year 6. All right. So now the timeline is now finite. All right, because we have just shifted our perspective from a long-term Warren Buffett type investor to a short-term myopic investor. All right, so I'm just going to copy everything and paste it here. This is now a finite timeline because the stock actually has been sold at the end of year 6. All right, so I'm going to look at cash flow per period. So in year 6, the investor is going to collect the last period of dividend, and then the investor is going to sell the stock for $69.97. So the total is going to be 72.67. All right. And then, prior to that, there's one more dividend for the investor to pick up. That's $2.58 in year 5. All right. So, if I want to make a little analogy between the cash flows from this particular stock versus the cash flows from a bond, then really there's actually something in common. All right. The resale price is like the face value of the bond. When the bond matures, you receive the face value. Now, before the bond matures, you receive the coupon. So these dividends, they are like the coupon cash flows. Okay, so really, we call this, bonds versus, equities, and we call them, coupons versus dividends. We call them, face value versus the resale price. But really, the underlying thought, the underlying logic is actually very similar. All right. So now I can say present value of each cash flow. So I need to discount them again. So I'm going to do the discounting here. So that's 1 plus the equity cost of the capital, which is 8%, raised to the power of 5, because it takes 5 years for the investor to get this cash flow. All right. So that's $1.76. Okay. And I can copy this across. And now I can actually say present value of all cash flows. And in this case, it's going to be the summation of these present values. And that's going to be the stock price. And some of you are still thinking about, the NPV function here. So can I do the NPV function here? So the rate is going to be 8%. And the future cash flows here would be, these are the future cash flows. Okay. So if I do that, well, it looks like Excel, is actually, producing different numbers here. So, if I actually put down 0, all right, okay, well, I actually get the correct number here. All right, so it looks like if you're going to use NPV function, then whether you actually have blank cells versus, cells that actually contain 0, that's actually going to make a difference for the NPV function. All right, so you would think blank cells are zeros, but Excel NPV function does not think that way. So you would have to manually fill in the zeros, and then Excel says, all right, that 2.58 is the cash flow in year 5. All right, now there is no mistake. Okay. All right, so this is the stock price today. Okay, so this is a very simple example as well, and we just reviewed the basic steps again for dealing with non-constant dividend growth stock. All right, so as you can see in the real world, you may have to deal with a lot of similar situations where the dividend growth rate is going to be a little erratic, for the immediate future. but eventually you're going to assume the growth rate is going to stabilize. All right, as long as you are willing to assume that, you can actually crunch the numbers and get like a number for the stock price. Okay, all right. So that is the other example. All right. So let me now move on to the second kind of valuation approaches, which is actually let me just pick up my bullet points here. All right. So there's non-constant dividend growth stock, constant dividend growth stock, and now I'm going to look at the second kind of valuation approach, which is actually bullet point number 3, free cash flows valuation approach. Okay. All right. So let me just get through the basics, and then I'll move on to Excel's with examples. All right. So first of all, there are two kinds of free cash flows. All right. So one is the so-called free cash flow to the firm. All right. So that's the notation. One is the so-called free cash flow to equity holders. All right. So this is the alternative definition. Now this is the other kind of free cash flow. All right. So if you want to actually understand the difference between these two, all right. So let me just copy our definition and let me paste it here. So this is actually the free cash flow for the firm. All right. And I just copied this directly from the lecture notes. All right. And there's another definition for free cash flow to the firm's equity holders. Okay. All right, so that is the definition for the free cash flow to the firm's equity holders. Okay, so let's just look at this definitions for a second. All right, so free cash flow to the firm, that's actually defined as EBIT, which is earnings before interest and tax, multiplied by 1 minus the TAUC or TC, which is the tax rate, corporate income tax rate. All right, so we know the Biden administration is actually going to do something about the corporate income tax rate. Okay, plus the depreciation, minus capital expenditure, minus increase in NWC. Now, NWC stands for net working capital. All right, so this is going back to your Finance 201 and accounting classes. Okay, what's working capital, why there's a need for working capital, why working capital management is so important, why are some people saying cash is the king when there is like crisis, and so on and so forth. Okay. Now, free cash flow to the firm's equity holders, that's actually built upon the free cash flow to the firm. So that's actually the free cash flow to the firm minus interest expense times 1 minus TAUC plus the increases in net debt. So imagine, every year the company can actually retire old debt. The company can also issue additional new debt. And so there's going to be increase in the net debt, and that is now at the discretion of the shareholders. Of course, maybe the creditors don't like that, so they may actually put some constraints or restrictions in the debt covenant. All right. So for example, they may say if you actually have debt, then you may not pay dividends. All right. So that's actually something for you to discuss in your Finance 380, the advanced or intermediate corporate finance class. Okay. All right. So I want to emphasize that these are the so-called free cash flows. Really, they're not free. Okay. Nothing is free. There's no free lunch. Right. They're called free because these are the cash flows available to the firm or available to the firm's shareholders or equity holders. So in that sense, we say they are free, but really they're not free. According to our conventional wisdom. Okay. All right. So correspondingly, there are two kinds of discount rates. All right. So you have to be very careful because now you have free cash flows to the firm. To discount the free cash flows to the firm, use the weighted average cost of capital. All right. So you have to discount the free cash flow to the firm by looking at the weighted average cost of a capital, right? So that's the so-called WACC, right? That's something you have dealt with in Finance 201. Okay, if you're a little rusty, please pick up your lecture notes for Finance 201. All right, and to discount the free cash flow to the firm's equity holders, use the cost of equity. All right, so these are very different discount rates. I mean, of course, they're related, but when you discount the free cash flows, make sure you're using the right one. All right, I know some investor banks, when they interview candidates, they love to actually ask technical questions like this. For example, what is the definition for free cash flow to the firm? Should I be using the cost of equity or weighted average cost of capital to discount the free cash flow to the firm? For example, one investor bank called Jefferies. All right, some of you may have heard of this investor bank, and they have like a technical. Some people posted like a technical interview guide on a website called Wall Street Oasis. All right, so I'm doing a little Wall Street Oasis, okay, and you might want to check out this website. And I know some of the contents are actually fee-based, but if you're looking for investor bank jobs, you might want to actually pay the $200 and to get the content, or you can actually get the content from those from friends who may actually have done this before. All right, so that is the free cash flow and the discount rates. Okay, so this is actually very similar to, for instance, capital budgeting when there is inflation. Right, if there is inflation, now you actually have either the real discount rate or the nominal discount rate. So the real cash flows or the nominal cash flows. So you discount the real cash flows by the real discount rate. You discount the nominal cash flows by the nominal discount rate. All right, so same logic. All right, you want to have to make sure they match. All right, and now we're going to actually look at one example here, because the lecture note actually has very intimidating valuation equation. All right, so I'm going to just copy and paste the valuation equation here, and some of you might be turned off. So let me just move on to one example. All right, so these are the valuation equations, and don't be intimidated by this nasty form, because everything is going to be clear in a second. All right, example number 6 on your lecture note. Okay. All right, so please make sure you have the Excel. You have the lecture note on your side. All right, so Keynes Cole, all right, so KCP, this is a real company, had sales of $518 million in 2005. All right, suppose you expect the sales to grow at a 9% rate in 2006, but that this growth rate is going to slow down by 1% per year to the long run growth rate for this industry of 4% by 2011. All right, so we're talking about sales, and later when we discuss the financial planning model, we know sales are the so-called value drivers. All right, a company is actually valuable because the company can actually sell goods and services to its customers. Okay, so sales are very important. All right. And the sales growth is going to be 9% for 2006, and then it's going to slow down by 1% per year until it hits 4% by 2011. All right. So based on this company's past profitability and investment needs, you expect EBIT to be 9% of sales. Okay. So we're making in this assumption about EBIT margin. Is 9% of the sales, and increases in net working capital. That's going to be 10% of any increase in sales, because the company is growing. Our sales are growing, so you may have to actually devote more resources to working capital. All right, so working capital, net working capital, requirements. That's going to be 10% of increase in sales, and net investment, which is defined as the capital expenditure or the capex minus depreciation. That's going to be 8% of any increase in sales. All right. If this company has $100 million cash, $3 million debt, 21 million shares outstanding, and tax rate of 37%, and a weighted average cost of capital of 11%, what is your estimate of this company's stock in early 2006 or late 2005? All right. So what's the analysis here? Well, the analysis here is very simple. This is looking at all these accounting terms. We know this is we're looking for the stock price or the stock value, and we're actually looking at accounting terms that very much reminds us of the free cash flows. So this is a free cash flow valuation problem. All right, as we said earlier, there are two kinds of free cash flows. One is the free cash flow to the firm. One is the free cash flow to the firm's equity holders. So in this case, because it talks about a WACC, weighted average cost of capital. All right, so provided who is WACC? So it's probably free cash flows to the firm instead of free cash flows to the firm, to the firm's equity holders. Okay, so we need to discount those free cash flows to the firm. All right, so I'm going to build a timeline here, and this is before I do that, I have to match that with the year timeline. So this is 2005. All right, so 2005 is going to be interpreted as time point 0. Because we're looking for the stock price at the end of 2005 or early 2006. Okay, so this is 2006 now, and I'm going to copy this across. And again, this is actually infinite horizon. All right, so that is 2006, and 2005 is period 0. This is period 1, and we have all these periods. Okay. All right, so I have 11 periods for the moment. If that's not enough, I'll expand to more periods. So don't worry about it. All right. So now we're looking at the first one is sales. So for this, 2005 for Keynes call, the sales is actually $518 million. So I'm just going to type down 518. Okay, instead of looking at all the zeros. All right. And then we have the sales gross. Okay. And the sales growth is going to be 9% for 2006. All right. And so I'm modeling this, sales growth rate. And it's going to slow down by 1% per year until it hits 4%. All right. So this is going to be 9% minus 1%. So that's 8. So I copy across. That becomes 7, 6, 5, 4. All right. So that's going to be 4% by 2011. And thereafter is going to stay at 4%. Okay, so I'm just going to make a simple formula here, and that is the sales growth rate assumption. Okay, so immediately you can actually find out what are the sales for the future years. We have modeled here. So for year 1, that's going to be the previous year sales multiplied by 1 plus the 9% growth. Okay, so that's going to be $564.62 million. And I can copy this across. Okay. All right, so the sales, the company is growing. The sales are growing. That's great. And now we're looking at the next thing, which is actually EBIT. All right, according to the question, EBIT is actually 9% of sales. So I'm just going to say, let's look at the sales for 2006. Some of you may wonder, why don't you look at 2005? Well, remember, we're discounting the cash flows and we're still looking forward, right? So, what happened in 2005? Well, that affected the stock price in 2004, all right? So in 2005, I'm looking at 2006 and onwards, all right? So that's 564.62 times 9%, excuse me. And this is a good formula here, so I can copy this across. I get the EBIT for the other years. All right, so let's keep reading this question here. And then it says increases in net working capital. All right, and according to the question, it says increases in net working capital is going to be 10% of any increase in sales. So I'm looking at the sales increase. So that's going to be 2005 sales minus 2000, excuse me, 2006 sales minus 2005 sales, and that is actually multiplied by 10%. Okay, all right, 10%. So that is actually $4.662 million. That's the net working capital increase. Okay, all right, and now I can actually copy this across, and I get all the other increases in net working capital. Okay, all right, so let's keep reading the question. Net investment. All right, so net investment is defined as CapEx, capital expenditure, minus depreciation. All right, so that's 8% of any increase in sales. So again, that's going to be the sales increase. All right, so 2006 sales minus 2005 sales multiplied by 8%. Okay, so we're making all this simplifying assumptions. Apparently, we're trying to focus on the methodology. All right, so that is the CapEx minus depreciation. All right, and then we also have all the information, and I'll refer to them in a second. All right, so what should we do next? Well, we should probably start to think about, hey, what's the free cash flow here? Yes, because it looks like we have all these accounting terms here. So let's look at what is the free cash flow to the firm. And speaking of that, we should probably look at the definition here. And so let me just go up and bring it up with the definition down here. All right. So I'm going to look at the free cash flow to the firm in 2006. And I'm going by the definition. So that's EBIT multiplied by 1 minus the tax rate. That's 37%. Okay. Plus depreciation. Well, we don't have the depreciation. Minus capital expenditure, and we don't have capital expenditure by itself, but we do have the difference between these two. Okay, so I'm going to do minus capital expenditure plus depreciation. All right, so that will do it, and then minus increase in net working capital. So that's going to be the increase in net working capital. I'm implementing the definition here. All right, so the free cash flow to the firm in 2006, that's $23.62 million. And now I can actually copy this across. Okay, so I get the free cash flows to the firm in all the future years. I'm still dealing with the infinite horizon here. Now I have all this, so I can just delete that. All right, I just want to make sure we still have that definition. Okay, we do. All right, so that's the free cash flow to the firm. So now what? Well, so if you want to think of them as dividends, that's fine too. All right, except when you discount the dividends, well, you discount the dividends at the equity cost of capital. All right, so here, if I want to actually apply the Gordon model, because I need to cut the timeline, so one thing I have to do is to find out when this free cash flow growth rate stabilizes. I need that piece of information so that I can decide when I can actually start applying the Gordon model. All right, so this is now calculating the free cash flow growth rate. All right, so I'm going to look at the free cash flow growth rate, in 2007. So what I would do is very simple. I do free cash flow to the firm in 2007 minus 2006 free cash flow divided by 2006 free cash flow. So that's 11%. All right, and now I can actually copy this across. And now you start to see a pattern here. The free cash flow growth rate starts to stabilize, from 2012. Okay, so now if I want to think of them as dividends, that's fine, as I said. So we can actually apply the Gordon model, and we're going to calculate some kind of resale price. But when we use dividends, we call them resale price. Here, we're using the free cash flow, so we call that terminal value. All right, so we can actually calculate the terminal value here in 2012. Okay, all right, because the free cash flow growth rate stabilizes starting from 2012. Actually, you can do that for 2011. All right, but I don't want to cause any confusion. So let me just do the free cash, the terminal value in 2012. I'm still looking forward, so that's my next period of dividend or next period of free cash flow divided by R, which is the weighted average cost of capital, and that's 11%. That's provided. If you're an MBA student, we may ask you to actually estimate the WACC on your own. All right? You can actually pull up the financial information from, let's say, Capital IQ, and you can actually, estimate the WACC. All right, and then minus G, which is the constant free cash flow growth rate. So this way, we're calculating the terminal value. That's actually $580 million. All right, so now our timeline is finite. Okay, because we have successfully changed our perspective. All right, so I'm just going to copy everything up to period 12, and I'm going to do that. And actually, I don't need to look at all the cells, all the stuff, all right? Because all I need is actually the cash flow per period, okay? So I'm looking at period, 7 or year 2012. This is when this gigantic investor, whoever that investor might be, the investor is going to pick up the last period of free cash flow, and then the investor is going to sell the firm for $580 million. All right, so that's like the last coupon plus the face value, and then I'm going to copy this across, and I'm going to pick up all the other free cash flows. This formula is a little sloppy, but I'm okay because there is no terminal value in the first 6 periods, so I'm okay. All right, now I can actually say what's the present value of each cash flow here. All right, some of you want to actually try the MPV function. I'll do that in a second. All right, 1 plus the discount rate, which is 11% raised to the power of 1. So that's going to be the present value of, whoops, why is it giving me a percent sign there? All right, so that is 21.28. Okay, so I don't like the percent sign there. Let me just format that into a number. All right, and I don't need the dollar signs. All right, so that's $21.28 million. So now I can actually copy this across. I get the present value of all the other, cash flows, and present value of all cash flows. And if I just add them up, I would actually get, what is this number here? So that is 424.83. All right, and if you want to do the MPV function, that will replicate for sure. So the discount rate is 11, and we're looking at, the future cash flows. Okay, yes, that's 424.83. Now, what do we call this? If this is dividend, we call this stock price. Now, this is actually the the so-called enterprise value. All right, so Wall Street people actually refer to this as enterprise value. All right, so sometimes we just call this EV. All right, so what is enterprise value? All right, so let me just give you the definition here. Definition for enterprise value. Enterprise value is defined as the market value of equity plus debt minus cash. Okay, so that is how we actually define the enterprise value. So if you want, you can think of this, can view enterprise value as the cost of taking over the firm. So if you want to buy the firm, you have to pay for the market value of equity, you have to pay for the debt, and if the firm has cash, well, you can actually seize all the cash and use that to pay. So the existence of cash is going to actually reduce the cost of taking over the firm. And actually, in this case, Keynes Cole indeed has $100 million cash. That's a lot of cash. Maybe that is going to make this company a target for someone, a takeover target for some other companies, because other companies are looking at this and say, if we buy this Keynes Cole, we can actually seize all the cash. All right, that's 100 million. That's that's a lot of cash. Okay. All right. So if I want to actually get a stock price, I have to, from the definition, can back out market value for equity. So market value for equity is going to be equal to enterprise value minus debt plus cash. All right. So in this case, market value for equity is going to be, all right, I'm just going to take the numbers. So enterprise value, this number here, minus debt. So go back to the question. The debt is actually $3 million, and plus cash. The cash is actually 100 million. All right. So everything is in million. So that's going to be $521.83 million. That's the total market value. All right. So now I can actually say stock price per share. All right. What is this? Stock price per share. Well, that is the aggregate market value for equity divided by shares outstanding. And what's the shares outstanding? Do we have a number here? 21 million shares outstanding. Okay, so we just divide this by 21 because everything is a million. That's $24.84. All right, so that way we can actually value, this, Keynes Coal Company by discounting the free cash flow to the firm. All right, so now let me actually, bring up this firm value, valuation equation here. So if you want to think about this, all right, so in the valuation equation, all right, what are the, notations here? So first of all, the firm value in our Excel, in the equation, and this is, in the example, I just want to do the correspondence between these two. All right, in the equation, it's called the firm value. In the example, it's called enterprise value. Yes? All right, and, the VT, in the equation, there's a V capital T here, right? So I can just use V capital T here. So what is that? Well, that's actually the terminal value. Yes? That's the terminal value here. The capital T here, in our illustration, the capital T here is actually, year 2012 or period of 7. Okay, so T is actually equal to 7. All right. The G is the constant, growth rate for the free cash flow, which is actually 4%. All right, and R is, WACC. So in our illustration, the WACC is actually given. That's 11%. All right, so that is, a very easy mapping between the equation and, in our, Excel example. All right, so that is what I have left for the present value of the free cash flow to the, to the firm. If you want, you can actually do, the present value of the firm's equity holders, assuming you have information about, the increase in net debt and, interest expense and so on and so forth. All right. So I'm going to skip the rest of the valuation approaches. All right. So this is my bullet point number 4, valuation by multiples. All right. So I'm going to skip them. All right. And you can actually review the lecture note on your own. And it's actually very easy for you to understand. Okay. All right. So this video is now 43 minutes. So I think we can stop right here. And you just need to practice a few more questions about equity valuation. All right. So I'll stop the recording.